Alright guys, welcome back. In today's video, we're going to talk about basically why you just shouldn't mess with the stock market, essentially. Now, I'll say this. First off, you guys should really watch a show. It's on Showtime, actually. It's called Billions, alright? The main character is this guy named Bobby Axelrod. He has an equity firm. Essentially what happens is that if they want a particular stock to go up, they'll go to the competitor and they will contaminate, hurt, injure the operations of that competitor, which will basically flow the market in the direction of the other stock that they want to be successful. Okay? Watch this show. It will make a lot more sense when it comes to investing in the stock market and how it actually works. But the first thing I want you guys to think about is, what are stock? Stock are shares of equity, okay? Shares of equity. So now you have to ask yourself, well, what the hell is equity? And equity is really simple as far as a definition equation. Equity is assets minus the liability, okay? Assets minus liability. That equates to equity. So in this example, assets would be cash, sales, cash equivalents, property, inventory, computers, patents, right? All that's considered equity. Your liabilities consist of your debts, your IOUs, your payables, etc., okay? Now, that equates to your equity. So in this example, $10 million worth of property, cash, etc., for a company that's on the stock exchange. And all their debts, $5 million, would equate to equity of $5 million right here. And I want you guys to think about this. How in the world would the stock market know moment by moment where every single company with all their accounts, all their assets, all their property, all their cars, right? All their computers, all their inventory, that let's say at 9:52 a.m. on Monday, that the value of that company is $5 million. You would have to have people doing the calculation every nanosecond to see when or if the company's equity goes up, right? They don't do that. They don't do that. As a matter of fact, when you go public, you have your accounting team that reports to the SEC, and they don't report every 5 seconds. That's not how that works. So then you ask yourself, well, how in the world does equity how is the equity in the stock market so volatile? How does it go up and down so much? Because they factor in something called the brand of the company. Brand is another way of saying demand or hype, right? How popular is that brand that day? How often does someone search Facebook that day? How many users do they have that very second? And they're basically using the brand as the leverage or as the points to go up and down. The true value, is the base of what the company is worth. This is the true and real value, $5 million. But based on the brand at 9:52, they may increase that $5 million to $8 million, all right? So that means that those shares now become, they cost more money. Let me give you an example of that. Over here, like in the other video, we talk about Fiverr, right? Fiverr, when they did the calculations with their accountants and everything else, Fiverr was only worth $21 per share. When Fiverr went public, immediately it jumped from $21 to $26. Did anything change in the amount of sales that Fiverr had? No. Did Fiverr get more cars that day? No. Did Fiverr buy more buildings in that second? No. It was just the brand and the hype. So Fiverr went from $21 to $26. And then, based on more hype that took place that day, it got to a high of $41.68. Okay? That's almost double your money for nothing. It was just hype. Give me another example. Zoom. Did Zoom, I think you get where I'm coming from. Did Zoom add any assets? No. Zoom was valued at $36. It opened at 65, and it got a high of 66, right? Nothing changed that day with Zoom. They didn't make any more sales, all right? So, here's food for thought. Every market has a multiplier. That multiplier is based on how many competitors you have, and that's how they dictate what your opening price will be. 1. Number two, you have to understand what money is. Money is simply a collective belief, all right? We all know that money has no value, but yet we all work. Most of us do, at least. And we all have rent, mortgages, houses, properties that we exchange for money. What makes money valuable is the fact that you and I have an agreed belief on what a dollar is, what it could be traded for. The last thing you guys think about, the SEC. Every public company files an SEC form S1. The SEC, or this form particularly, began in 1933, right after the Great Depression. Let that sink in.